The Construction Market Guide is designed to provide timely information to construction executives to help them attract, train, and retain the most highly skilled workforce possible, to understand input costs and the direction of those material prices so they can bid as competitively as possible, and to understand the broader economic environment so they can forecast and make solid decisions for their firm. So here in November of 2019, as we take a look at the unemployment rate, the Federal Reserve Bank, which you hear people talking about, the Fed Chair Jerome Powell, has two mandates to keep the economy strong. One is to maintain low unemployment, and the other is modest inflation. As we take a look at employment, we see an incredible thing here. The unemployment rate in the construction industry is the lowest it's ever been since they started tracking it. So if you're having trouble finding good employees, you're not alone. It's a big challenge in the current environment. Looking at materials costs, we see prices have come down pretty significantly across the board. Oil prices down substantially, down 23%. Iron and steel prices down, really prices down across the board other than a modest increase in asphalt, paving, mixtures, and concrete. Moving on, looking at other construction indicators, we see new housing starts continue to expand, down a bit but continuing to grow. The total output of the United States economy, as measured by GDP, is continuing to grow, although at a slower rate. If that would go negative for 2 consecutive quarters, that's when we would be in a technical recession. That hasn't happened. It continues to grow. Looking at construction wages, if you're wondering what rate of pay increase you should see for your employees, across the industry, we see about a 2.19% annual change to wages. So there's the average increase construction workers are receiving in the industry. Something to keep in mind as you have key employees, you got to know that they're seeing wage increases and other companies are trying to recruit them away. So it's good to be mindful of wages of your employees and making sure they remain competitive in the current environment. For developers and builders and owners of real estate, as measured by the Wilshire U.S. Real Estate Investment Index, which includes industrial real estate, mixed office, malls, self-storage facilities, healthcare, hotels, apartments, strip centers, combination of all those things, we see substantial increases, up almost 22% over the last year in real estate prices. So that tends to be a good sign for continued expansion in construction. Looking at bonds and interest rates, we see interest rates had dropped substantially. They're now starting to rise a bit again. But we saw recently that the 2-year bond, if you lend money to the U.S. government for a 2-year time period, as compared to a 10-year time period, traditionally you get a higher rate of interest for a longer term loan of 10 years versus 2. Recently that inverted, which is an indicator of possible future recession, but that flipped again and we're back to more normalized conditions now. So that's a good sign. Looking at the stock market as a whole, for construction executives and owners who are diversifying out of their companies into either 401k accounts or other investment accounts in the broader stock market, it's been a great year for stocks. Stocks are up over 22% so far this year here in the United States and up almost 12% over the last 12 months. So it continues to be, while things have slowed a bit, we're continuing to see continued growth and a positive environment for the future.